I remember staring at my 401k enrollment form, my eyes glazing over at all the fund options, and thinking, why does this have to be so complicated? All I want to do is save for retirement without needing a finance degree. Honestly, it felt like deciphering ancient hieroglyphs. I knew investing was important, but the sheer number of choices, the jargon, the fear of making the wrong move, it was paralyzing. If you've ever felt that way, you are absolutely not alone. Fast forward a few years, and I discovered a simpler path that many people unknowingly use, or are at least offered: target date funds. These are often presented as the easy button for retirement investing. But are they really the perfect solution for everyone? Today, we're going to pull back the curtain and talk about the pros and cons of target date funds, so you can make an informed decision about whether they fit into your financial picture. Think of this as our coffee chat, where we break down something that seems complex into something totally understandable. Let's dive into the good stuff first. But first, what makes them so popular? Here's why so many people swear by them. The pros. Why target date funds can be a game changer. 1. Unbeatable simplicity and automation. This is hands down the biggest selling point. A target date fund is essentially an entire investment portfolio in one single fund. You pick a fund with a target retirement year, say 2050 or 2060, and that's it. You don't need to pick individual stocks, bonds, or even different index funds. The fund managers handle all of that for you. It's the ultimate set-it-and-forget-it solution, especially if you're just starting out, or if you simply don't have the time or interest to actively manage your investments. For someone like my younger self, staring at that overwhelming 401k form, this would have been a godsend. It removes so much of the stress and decision fatigue from investing. 2. Built-in diversification. One of the golden rules of investing is diversification. Don't put all your eggs in one basket. Target date funds are inherently diversified. They typically hold a mix of different asset classes, usually domestic stocks, international stocks, and various types of bonds. This broad exposure means you're not overly reliant on any single company, industry, or even country. If one area of the market is struggling, another might be doing well, helping to smooth out the ride. This reduces your overall risk without you having to manually research and buy dozens of different investments. They often offer global diversification too, which is fantastic. 3. Automatic rebalancing and the glide path. This next part is where target date funds really show their cleverness and why they're often called the easy button. As you get closer to your target retirement date, the fund automatically adjusts its asset allocation. This is called the glide path. When you're young and retirement is decades away, your fund will typically be more aggressive, with a higher percentage of stocks, which have higher growth potential but also more volatility. As you approach retirement, the fund gradually shifts to a more conservative allocation, increasing its holdings in bonds, which are generally less volatile and provide income, helping to preserve your capital. This de-risking process happens automatically, without you lifting a finger. You don't have to worry about selling stocks and buying bonds as you age. The fund does it for you. It's like having a personal financial advisor automatically tweaking your portfolio over the decades to match your changing risk tolerance. 4. Accessibility and low barrier to entry. Target date funds are incredibly accessible. They're a staple in most workplace retirement plans, like 401ks and 403bs, and are often the default investment option if you don't choose anything else. This makes it super easy for people to start investing for retirement from day one of their careers. You don't need a large sum of money to start, and you don't need to open multiple accounts. For many, it's the simplest way to take advantage of employer matching contributions and kickstart their retirement savings. So, target date funds sound pretty fantastic, right? A hands-off, diversified, automatically adjusted portfolio for retirement. What's not to love? Well, not so fast. Here's what most people miss, and why you must understand the potential downsides. The cons. Where target date funds might fall short. 5. Expense ratios and fees can be higher. This is a big one, and it's where paying attention truly pays off, because target date funds are actively managed. Even if they're based on index funds and bundled, They often come with higher expense ratios compared to simply buying a few low-cost, broad market index funds on your own. For example, you might find a good target date fund with an expense ratio around 0.30% to 0.70%. While this might seem small, let's put it into perspective. If you invested $10,000 for 30 years with an average 7% annual return, a 0.3% fee would cost you over $10,000 in lost growth compared to a fund with a 0.05% fee. That's a significant amount. You could buy a broad market S&P 500 index fund or total stock market index fund for as low as 0.03% to 0.5% in many cases. Over decades, those seemingly small differences in fees can compound into hundreds of thousands of dollars. Always check the expense ratio of the specific target date fund you're considering. 6. The one-size-fits-all problem. This next potential drawback is often overlooked, but it's crucial for your long-term wealth because it might not be a perfect fit. While the automation is a pro, it can also be a con because target date funds assume a generic investor profile. They design their glide path based on a typical risk tolerance for someone retiring in a specific year. But your situation might be different. Maybe you have a pension, so you can afford to be more aggressive. Or perhaps you're naturally very risk-averse, even if you're young. Or maybe you plan to work part-time in retirement, meaning your need for income might be less immediate. A target date fund can't account for these individual nuances. It treats everyone with the same retirement year as having the same needs and risk tolerance, which simply isn't always true. It's like buying a suit off the rack. It might fit most people reasonably well, but it's rarely a perfect tailor-made fit. 7. Lack of control and transparency. When you invest in a target date fund, you're essentially handing over control of your asset allocation to the fund manager. You might not know the exact mix of underlying funds or understand why certain changes are being made. While the general principle of the glide path is clear, the specifics of how much is in international bonds versus domestic stocks at any given time might be opaque to the average investor. If you're someone who likes to have a deeper understanding and more direct control over your investments, or if you want to apply specific investment philosophies like ESG investing or specific factor investing, a target date fund might feel too restrictive. You're trusting their decisions completely. 8. Potential for tax inefficiency in taxable accounts. This is less of an issue if you're investing in a tax-advantaged account like a 401k or IRA, which is where most people use target date funds. However, if you were to hold a target date fund in a regular taxable brokerage account, the automatic rebalancing can trigger capital gains taxes each year. As the fund sells certain assets to buy others to maintain its glide path, those sales can create taxable events even if you don't sell any shares yourself. This is usually not a concern for the majority of people using TDFs for retirement in tax-advantaged accounts, but it's a good nuance to be aware of if you're thinking outside the box. So where does that leave us? Are target date funds good or bad? The truth, like most things in personal finance, is that it's not black and white. Target date funds are an excellent option for beginners, for those who want a completely hands-off approach, or for anyone who feels overwhelmed by investment choices. They ensure you're diversified and automatically adjust your risk as you age, which prevents many common investing mistakes. They provide a fantastic foundation for your retirement savings. However, if you're comfortable doing a little more research, have a specific risk tolerance that deviates from the average, or if you're keenly aware of fees, you might be able to build a similar, slightly cheaper route and more customized portfolio using a handful of low-cost index funds or ETFs. But that requires more knowledge, more effort, and more ongoing management from your side. Here's your actionable takeaway for today. If you have a target date fund in your retirement account, go look up its expense ratio. Many workplace plans have a portal where you can find this information. Compare it to the expense ratios of other funds offered in your plan, especially broad market index funds. Understand what you're paying and if it aligns with the convenience you're getting. If you're happy with the simplicity and the fees are reasonable, fantastic. If the fees are very high, or you're curious about taking a more hands-on approach, that's your cue to do a little more digging. Knowledge is power, and even a small percentage point difference in fees can make a huge impact over decades. Now, before we wrap up, a quick but important reminder. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making financial decisions. What do you think about target date funds? Are you using one, or have you opted for a different strategy? Let me know in the comments below. I love hearing your experiences. If you found this video helpful, please hit that like button, subscribe to the channel for more friendly financial chats, and share this with anyone who's feeling a little lost in the investing world. Thanks for hanging out, and I'll see you in the next video.